Hello, everyone, and welcome to another episode of Between Two Brokers. Today, we are entering the exciting world of accounting. Actually, our most listened to episode ever, most downloaded episode ever, featured the wonderful Stephanie Spinucci, our Italian girl, Carr, Riggs, and Ingram, or CRI, and we have a new guest, Nick Rafferty, who also has his own podcast, which we're going to have to talk about later. Welcome, guys. Thank you so much for joining us.
Thank you.
I'm probably going to let Erin direct all of the questions because she is the money and organizational part of Smith Spencer, and I'm the
just the spender.
The free-flowing idea person.
You're the one who brings the fun. You're the one who keeps her in check.
No fun.
Y'all are great.
Fun. Yes, no fun. You
Y'all
used
are great.
to be fun.
I'm fun in a different way.
No, I'm with you. Erin and I are a lot alike.
Yeah, and just keep me out of it so everything stays straight.
Who would have thought accounting would be our number one downloaded episode out of, I don't know how many episodes we have now, but 3 years. And
Yeah.
you're still number one.
It's because people don't want to pay taxes and they want to know what they can deduct.
Yeah.
Everybody's obsessed with money.
Yes.
That's my theory.
Yes.
Yeah. So what has changed, like big things since the last time we've had you on, which I think was that last year or 2 years ago?
2 years ago.
2 years
2
ago.
years ago, yeah. We talked about a lot of year-end planning and what you can deduct if you are I think because you said a lot of your audience are real estate agents. They both this commission income, 1099 income, taxes aren't withheld from that. So what can I write off so I'm not paying a ton of taxes? A lot of that, I don't want to kind of repeat if people still listen to that one, but the biggest thing that has changed since then is the write-off for your vehicle. So when we met last, you could potentially write off up to 100% of the cost of your vehicle through bonus depreciation, assuming the vehicle was more than 6,000 pounds, so think of your larger SUVs, and then use more than 50% for business. That has dropped in 2023 to 80%. In 2024, it drops to 60%. 2025 drops to 40, then 20, and so forth till it's done. So not as big of a benefit if you were to buy a vehicle in 2023 as if you had bought one in 2022, but still a great write-off, especially for my clients who are buying the larger SUVs. And I say large SUVs, I think something like a Toyota Highlander fully loaded meets the $6,000. So it doesn't necessarily have to be
6,000 pounds.
Sorry, 6,000 pounds.
$6,000 would be wow.
Get you a golf cart. Yeah.
Not even. A really used one that's
You're right.
janky.
You're right.
Do you know why that deduction was even like...
Has changed.
No, why was it made in the first place? Like, why would you give somebody a deduction for buying a huge gas guzzler?
I believe going way back, probably when I even started my career, they called it the Hummer deduction. So back when the Hummers were super popular, say in the early 2000s, and they were trying to, like, how can people write off these large vehicles? That's the only thing that I can kind of think of back. You go way back in history if they thought, okay, well, let's set this weight limit to try to get people to buy the larger trucks and SUVs. And who knows? It's all, half of it's political.
Yeah.
So who knows who had the political money kind of pushing that stuff through.
Spend more money on cars and gas.
Yeah.
Right.
And how often can you buy a new car? How many?
As often as you want. I don't want to say that, but you need to be aware that if you were to sell the vehicle and you had depreciated it, meaning you took that big write-off, you have no basis in it. So when you go to sell it, whatever the trade-in value or if just sales price, less your basis is capital gain. So you're faced with a capital gain, but you front-loaded that depreciation. So that's kind of a 5-year rule,
okay,
because the IRS essentially wants to be made whole. So you depreciate the vehicle over 5 years in sort of the general rule, but then you can make this bonus depreciation election to front load that depreciation in year one. So you get rid of it before the 5 years. The IRS is like, wait a minute, we need to treat this as if you had had it 5 years, and we want to recapture that depreciation that you took previously.
Okay. Because I always remember
Like
she used
Mandarin to me.
I know.
Just like, why am I here?
My brain does feel scrambled already.
No.
We just appreciated it when you would say, Stacy can buy a new car
Yes,
in
just tell me what
2021.
you do,
Erin, you can
Stephanie.
buy one
She
in
knows.
2022. And I did just buy a new car this year. Does it matter if you pay cash or finance it?
Does not matter.
Yep.
So the IRS only looks at your purchase price. Now, if you lease it, that's a different story. But either when you purchase the vehicle, it doesn't matter whether you pay cash or whether you finance it. We'll always look at the purchase price.
Are there any other kind of vehicle incentives out there, like electric vehicles or anything like that?
So there is electric vehicle incentives out there. It's harder. I don't want to say harder to get those incentives now. The rules have changed. Previously, there was not income limitations. Now there are income limitations on whether or not you can take an EV credit. I'm not armed with those numbers, but if you make over a certain amount, you don't get to take an EV credit. Now, it opened it up. The old law was based on number of vehicles sold. So, for example, Tesla, they sold out real quick. So you couldn't get the credit if you bought a Tesla, after like 2018 or 2019. But plenty of other manufacturers made EVs. So if you wanted to get an EV, an Audi EV, they still had enough. They hadn't hit their cap of sales. That was old law. And there wasn't a cap on your income level and whether or not you could take that credit. New law opens it back up to everyone again. So the whole Tesla capped out, that's not a thing anymore. We opened it back up. But if you make too much money, gosh, I wish I could remember the income levels. A lot of my clients don't qualify at that point. So
She only works with rich people.
I think what happened was they were trying to get lower income earners to start buying
Right.
EVs.
That makes sense.
So that's where the credit's still very generous, but now there's an income cap.
Can you use both of these tax, credit and deduction for the...
I would imagine that the credit would reduce the basis in the vehicle, so you wouldn't be able to take as much. But you can still do both of them.
Okay.
Just you're not going to get a double dip of benefit.
That's
Right.
essentially.
Okay.
They figured that out.
Okay. Nick, shit. Is it Nick?
It's Nick. Yeah.
I was like, wait,
Why did you look at me? I thought the second he walked in and said Nick, I was like, well, this is easy.
Yeah, well, I didn't remembered his last name. Okay, sorry.
Rafferty.
Tell us your story.
Yeah.
We already know Stephanie's.
Life story. Just
Why accounting?
but make it short.
Why accounting?
Why accounting?
Why? I mean, just because I took my intro to accounting and it just kind of clicked with me. I think that the intro levels in college are kind of like the weed out courses, and for most people, it either clicks or it doesn't.
Yep.
And it just kind of clicked with me. The debits and credits made sense, and it just kind of went from there.
Where'd you go to college?
To the University of Dayton. It's out in Ohio.
Okay.
For those who don't know. Yeah, it's not the biggest school. We have a good basketball team, but besides that,
Is that where you're
not
from?
really too
Ohio?
much. So I grew up in Philadelphia, and then I got a decent scholarship to Dayton, so I just figured I would go there. And then after there, I moved to Wisconsin for a couple years, and then I moved down here about a year ago and started with Stephanie and the Landing Group, which then became CRI.
Yep. Okay, and you love accounting.
I do, yeah. It just, I don't know. I just like spreadsheets, numbers, stuff like that.
Stacy.
It's,
I mean, thank God we're all different.
Stacy's
but
like-
thank God we're all different.
yeah,
Are you a CPA?
I am. I just recently became licensed in July.
Congratulations.
Thank
What
you.
does it take to become a CPA?
So you need 150 credit hours of schooling, which for a lot of people that can be prohibitive because that's essentially like a master's degree.
Yeah, for sure.
And then you have to pass 4 tests in a matter of, well, now it's 30 months.
30 months,
But
it
when I
was
passed,
18.
it was 18 months.
Yeah.
And those take a lot of, I mean, each one I think is estimated for like 150 hours of studying or so. So it takes a decent amount of time.
And then what's the benefit to being a CPA? Do you get paid more? Is it just like, yeah, okay.
And it's kind of street cred.
Yeah,
I
for
feel
sure.
like. I'll
For
never
sure.
forget a meeting I was in, Carrie had a new client meeting that she couldn't be in. And so she's like, Steph, do the meeting, but she didn't do an intro. And so I remember sitting in the meeting. I was fully prepared. This was a business owner. We had financials. We were going through. And she stopped me in my tracks and said, are you even a CPA?
Oh, boy.
And I was like, yes, ma'am, I am.
Yeah.
So I feel like it's a little bit of street cred, too,
Definitely.
having those
Sure.
letters behind your name. Certainly, there are a lot of accountants out there that I've worked with that know their stuff, but they just can't seem to pass that test. It's really...
Is it hard?
I mean, I think as long as you put the time in to study, most people would, or I don't know about most, but a decent amount of people would be able to pass it. It's largely putting the time in to actually learn the material.
Mm-hmm. How long does the test take?
The test? You mean like the...
When you sit for
Are you going to become a CPA
No,
now?
I'm just maybe.
Yeah, I mean, like the tests are 4 hours each. Is that... Yeah.
Yeah.
And then...
And if you fail, you can just keep taking it.
You can, but once you pass your first one, you have a clock that starts, which is 30 months now. And then if you can't pass the rest of them within that time, then they start dropping off and you have to retake them.
Okay.
That sucks.
So what have you learned now in your year at CRI that has been a surprise? Is there anything about the actual work? You know, you think you want to be an accountant. Well, now you're in it.
Mm-hmm. Yeah, just a lot of the planning part, like that's all new to me, like the retirement planning, how to minimize, tax liability in the current year, and just mostly the planning type stuff.
So being how they're proactive with their clients.
Right. Rather than reactive and
Right.
just doing the compliance piece and just looking backwards. So, yeah.
That's cool.
And year-end projections. You brought that up when you walked in today because we're due for that. Talk a little bit about that, the importance of them or what they do. Yeah.
We don't like surprises, and we have some clients who don't.
It's always a surprise. I mean, you don't like... That's fine, but
the planning helps. Okay, what can we do? Let's see where you stand now. How's this year looking like it's going to shake out? And then what can you do between now and year end to make this answer better? Mm-hmm. And so we like to give those suggestions. We do that with you guys. We gather your financial data. What have you made so far? What do we think the rest of the year is going to look like? What's max for retirement? Make sure you do that. And then we usually send it to you guys with the bullet points. All right, here's where you land. Here's some things you could do to make this answer better, some actions to take by year end. But you can expect to owe X and Y come April 15th. Mm-hmm. Or if you file an extension, you have to pay that with your extension payment. The planning piece, because then that gives you some time to say, oh gosh, I need to come up with X by April. That gives you a solid 5-6 months to kind of be mentally prepared for that. I hate dropping tax bombs on we're wrapping up your return and oh my gosh, I have to call someone and tell them they owe $20,000, $50,000 and they are not expecting it. We likely didn't do year-end planning because they didn't engage some people just want to stick their head in the sand and they just ignore me when I reach out. But others are a little more proactive, like you guys. Mm-hmm. That want to kind of plan for that. Yes. Stacy doesn't want to know, but we're going to tell her.
So an example might be, this is something that we're discussing right now. Like our office is just one big room. Mm-hmm. We do have a little conference room, but the more agents that we hire, we're up to 24 now. It's a little difficult to have a private conversation. Mm-hmm. So we're looking at these 2 phone booths that are like nice pieces of furniture, but it's going to be like $15,000. Yeah. So it's like once you do our projections, you're like, hey, you guys really need to purchase those this year, or let's wait till next year, something like that. A big write-off.
Exactly. That would be a nice write-off. So kind of general recommendations would be, anything you can invest in your business, that will be a business write-off.
Marketing expense.
Marketing, if you need new computers, new iPhones, new iPads, furniture, any kind of equipment, if you can front load that into this year and get that write-off this year, that will help reduce your taxable income. What doesn't reduce your taxable income is you pulling the money out to go on a personal vacation. Now, that's an owner draw. That's not going to reduce the net income of the business and what's going to be taxed to you. So think about what a Christmas party for the staff. Think of those things to kind of utilize in the business before year end.
But if you don't have the money.
So then the question is, well, where'd the money go? Did you take it to use personally? Because that didn't reduce your bottom line. But if you have the cash, the profits that you haven't taken out to use personally, throw it back in the business.
Right. But I'm saying like you shouldn't go throw a staff party on a credit card because you actually don't have the revenue left in the business.
So if you throw it on a credit card, it's still a deduction, even though you didn't have the cash outlay. If you made the credit card charge in 2023, it's a deduction. Now, can you pay your credit card bill in January 24 is the bigger question.
Right.
You know, some just float that balance. Others want to pay that off every month.
Vacations. So what vacations or trips travel is a deduction?
Great question. So the trip has to have a business purpose for you to be able to write it off in your business. Some of my like real estate developers are always looking for the next deal. They're looking for the next hotel to invest in. So if the primary purpose of their trip to Hawaii was to look at, you know, properties to invest in, then that would be a business deduction.
Okay, can we just rename me a real estate developer?
You're not developing real estate.
Yeah, I am.
But
Decorating my house.
if you are, you know, you go to a conference in Colorado, you know, and it was the National Association of Realtor conference, and the primary purpose of that trip was business, then we can write off your airfare, your lodging.
Yeah, I had a surprise because, like, I went on a couple of trips with clients, and I just had the idea that because I was with a client that it was it was a write-off. But
were y'all looking at properties to buy for that client?
No, but we were discussing, you know,
business.
Yeah, absolutely, and discussing real estate and looking at real estate together while we're there. So that was a big surprise to me.
It has to be primary purpose.
Yeah, well, that sucks.
Well, maybe let's look at the meals. Let's kind of not go crazy, but you know, you were dining with clients while on and talking real estate. So maybe let's take that, but not the whole airfare.
Yeah, got it.
All the things.
Yeah.
Speaking of meals, I know during COVID, they were restaurant meals were 100% write off. Now they're 50.
We're back to 50.
And that will probably stay that way.
Yeah. So historically they were 50, and then for 2021 in 2022, they did it, or they changed it to 100% to promote people to get back out into restaurants. We joked and said the 3 martini lunches were back.
Yeah.
But now 2023, we're back to 50% deductible. So still not all loss. I mean, you still get a deduction, but it's just not a 100% write-off. And entertainment, not deductible.
Nothing.
So pre kind of Trump tax bill years ago, you could write off 50% of golf, you know, entertainment, go to a sporting event, take clients to a sporting event, that's entertainment, used to be 50%. That's non-deductible. And that did not change with any COVID provisions, just straight up non-deductible.
Okay. What else? Like, we just had a recent episode where Giovanna in our office asked what we were doing for marketing, and my response is, you know, I like don't pay for leads or anything, but I do like to entertain. If I'm throwing like a Christmas party at my house and I'm only inviting clients, is that 100% write off all my food and drink and everything? Yeah,
that is.
Okay.
Same with your staff. If you do a Christmas party for the staff.
Okay.
You guys brought some very organized notes. And so I think you should talk about some of the things on there.
We didn't want to do a complete repeat of the last podcast, so I'm glad we talked about just some of the changes since then. So if anybody wanted to listen to more in depth about, I think we talked about home office deductions. I mean, we really got into a lot of deductions. Entity structure, I actually just listened to it on my road trip. Last week, I went on a little road trip and said, let me listen to that old podcast, see what we discussed. So we're not repeating. But one thing we thought we would bring up today would be rentals.
Okay, hold on. Before we get to rentals, I have a question just because you brought up home office. And I don't know if we talked about this on the last podcast, but I have read that oftentimes it's not worth deducting your home office square footage because then you are charged a tax rate of 6% for that square footage, and that it often doesn't, it's not a wash, it's like a negative effect.
So when you apply for your 4%, they look at that year's tax return. So if you're not claiming home office, then whole house is 4%. So it's rare that they go back and look again.
Okay.
So we usually say, the year you purchased the house, let's not.
Not right. Okay.
But then after that, now the county could change that rule. So I want to say there is that risk.
Hopefully there's no government officials listening to this.
Yeah.
Well, but wait though. But then they would then they would have to come to you and say, provide us your tax return. That's not going to happen. Yeah, come on now. No. Okay.
And then they would take, say you claim 10% home office use. They would say, okay, well, 10% of your home is at 6%.
Right.
Yep.
And the rest. So.
Okay.
Yeah.
Okay. On to rentals.
question.
Thank you.
So rentals. So a lot of people will ask us about, like, how do I reduce my W-2 income? How do I, right? And of course, real estate's hot, and Charleston is hot with rentals, short-term rentals, long-term rentals, both. Rental properties. So kind of bare bones, general rule, and then we'll talk about the exceptions. General rule is your losses from rentals are not deductible against your other income. Those are considered passive losses. So you take your rent income collected less all your expenses, and we can talk about what those expenses are. If that bottom line, and depreciation, if that bottom line is a loss, in general, you can't take that against all of your other income.
Why not?
So you want to rewind to like 1980s, and before the passive activity loss rules were in place, someone with I always pick on doctors, but I say a doctor who makes $1 million in their practice, they were running out and buying real estate like crazy in the 80s, producing losses because of depreciation deduction and writing that off against their practice income. Well, the IRS came in with the 1986 Act before I was practicing, but if you want to talk about a little bit of history, came in and said, we're shutting that down. You can't do that. That we're going to create a passive bucket of income and losses and a non-passive. And real estate is considered passive. So you can't gobble up real estate that produces losses to offset your working income.
That makes sense. I have always thought that one of the reasons that very, very wealthy people buy restaurants is so that they can have a tax, like the restaurants always lose money, right?
To have the write-off.
Yeah.
So that was sort of how those rules came into play. But then our real estate professionals spoke up and said, wait a minute, we are in the business of real estate. You're trying to tell me we have to still treat rental losses as passive? Well, what about us? So they came up with some exceptions if you qualify as a real estate professional and you materially participate in your rental, then you can deduct those losses against the rest of your income. So they kind of came in and said bare bones and then said, okay, well, here's some exceptions. Not all lost, though, if you don't meet those exceptions. You could still cash flow positive on your property, which then results in a tax loss after depreciation. You can't take the loss, but guess what? You just wiped out income. Now that loss isn't all lost. It's kind of carried forward in a little passive activity loss bucket that you can use in a future year where you have net rent income, or in a year you sell the property. Those losses dump out. And I've seen cases, I have thinking of a tax return right now, the losses from the rental were considered passive, can only get it down to zero, couldn't take the loss, carried forward. They sell the rental for a gain, but that passive activity loss released in the year of sale and offset the gain.
And there's no time limit on that.
No, just keeps carrying forward.
Materially participate is a new term to me. Is that what I think it means?
Yes.
Okay.
So kind of there's a long list of rules, but kind of a hard and fast, and this is where I made my notes. Okay, material participation. So you have to spend more than 500 hours in that property or 100 hours and no more than anyone else. Those are kind of the two bare bones. And then the question is, well, what constitutes hours? You know,
Yeah. And
what
how
are
do
we
you prove
talking
it?
here?
Do you need to like write it down? Hey, I arrived at the property at 6 p.m.
IRS would love to see a log if you're ever audited of the hours you spent and what you were doing. So what doesn't count as hours is traveling to see the property. And also what doesn't count as hours are investor type activity like, oh, I just review the financial statements. They want you kind of doing the bookings, getting the place set up to be rented, coordinating the furniture delivery. Those are all hours.
Can you write off the gas you use to travel to the place?
You can write off, but your hours traveling cannot count toward those
Okay.
hours. So that's now then there's another caveat to that. What if you own multiple rental properties? We are able to make a grouping election. So you don't have to meet the material participation test in each property individually. We can group them on your tax return via a grouping election to where you meet that material participation test among all properties you own, which makes it much easier to meet. We do all that, ladies. I've just done this to Stacy, but no, we're taking care of you on that front.
Yes, thank you.
Doing all of those things. It just may not have always been explained in such detail.
Yeah, we don't want to know.
Okay.
I don't think.
What percentage of your clients own rental property?
A lot.
Fair amount do.
Definitely
yeah.
more
I
than
mean,
50%,
Yeah.
I would say, for sure. Some multiples, some just one-offs.
What percentage of your clients file an extension?
My clients, I'd say Carrie's clients probably file more extensions than my clients. A lot of mine file in the spring and don't extend. But I'd say our practice, probably 50-50.
Wow.
You know, we're pretty busy in the summer. And then when we get around the extension deadlines, it's like tax season round 2.
Yeah.
Yeah.
You know, and those are usually the harder returns or the procrastinators
Yeah.
that just want to bury their head in the sand, or they're waiting on that last K1,
Yeah.
you know, and then you know how that is.
Yeah.
So you can't file till you have all of that information. So.
How many clients do you think you'll have? Do you know?
In the whole practice, or
I think more in terms of number of tax returns we file rather than, one client could have multiple tax returns,
Right.
Depending on what they're in. So if I just think of number of tax returns our firm files, between 1,000 and 1,500.
Wow.
We're back to taking on new clients, so that number is constantly changing.
Yeah. And I know y'all send out an email that's like, you guys got to have, if you want to file on time, you got to have everything to me by, I don't know what it is, March 1st, February 1st, something
Cut-off
like that.
deadlines.
So if all 1,500 returns came to you by your deadline, you could file them on time.
Probably not.
Yeah.
But
you know that they're going to extend.
We know certain ones have no choice
Yeah.
because they're waiting on K1s or things like that. And, the beauty of an extension is that it just gives you more time. I had a handful of clients, maybe 10 as we neared April 15th last year, that there was just not enough time in the day at that point.
Yeah.
Everything kind of dropped at one point, and that's the beauty of an extension. And I just reached out to them and said, do you mind if we go ahead and extend? You really would benefit you if I had a clearer head and not running off of, minimal sleep. And I assure you we'll get you filed by end of May, but at least I would have a well-rested brain to take another look at this. Yeah. And there's a misconception. I think many, many years ago, people thought filing an extension was like an audit flag. It is not at all. So if anything, I need to let my client know, hey, we've gotten your return to a good place. We still would like to extend. It looks like you're going to owe about X. You may want to go ahead and make an extension payment, because the IRS gives you an extension of time to file, not to pay.
Right.
So they will hit you with interest and penalties if you pay with your tax return after April.
Okay.
Otherwise, everybody would wait. Everybody would sit back and say, just wait till I file my taxes before I pay the money.
Right.
Yeah, they figured that out.
Okay. What's on your note sheet?
Note sheet. So I guess we can start with the difference between, a short-term and a long-term rental.
Yes.
And the main differentiator is that a short-term rental is an average of 7 days or less. So think of like mainly your vacation rentals or your Airbnbs. The one caveat with that, though, is that if you have somewhere like Isle of Palms, where you own a property that's really popular, in the summer months where you easily are hitting the 7 days or less. But when it comes to the winter, people sometimes, will rent like a couple months at a time, and that might blow the short-term rental, and then it'll become a long-term.
What's the difference?
The difference
tax-wise.
So the main difference is that on a short-term rental, you can deduct your losses if you material participate and you're not a real estate professional. So just your average Joe that, spends over 100 hours on their rental property can deduct their losses. Whereas if you have a long-term rental, you have to be a real estate professional, which is, someone like yourselves who's a real estate agent, or if you work in the construction industry, you can deduct your losses on a long-term rental only if you are in one of those industries and also material participate. Whereas for the short term, you don't have to be a real estate professional.
So when I had my Airbnb in Park Circle, I would have snowbirds that came for January and February. But when I turned my stuff into you guys at the end of the year, I don't think a breakdown of everyone's stay was included in that. Like, am I paying something different for the 2-month stay as the 7 day stays?
No.
Okay.
We still took the losses for you regardless of the status.
Okay.
I think what to hone in on with the short term is that you can not be in the real estate profession and have a short term rental and materially participate, and it only has to be one of the spouses. So I have, again, like to pick on the doctors, but I have a client who's a doctor, but his wife materially participated in their short-term rental. So neither one of them are a real estate professional. Had the short-term rental, she materially participated. They were able to take the losses because one of them materially participated. So, and when we say losses, we mean your gross rent income that you earn, and then any deductions that we can take. Mortgage interest, so not your whole mortgage payment. I think that might be a misconception. Mortgage interest, real estate taxes, insurance. Oh my gosh, you think of Airbnbs and you're like linens and, all the things. And then depreciating the property as well. That typically gets you down to a loss for tax purposes. And then the question becomes, can I take that loss this year? Or can I just take zero with the loss carrying forward? And that's when you go to the material participation test.
Okay.
But you guys are at kind of a benefit because we can group your rentals. You're in the real estate profession. Y'all are kind of a different animal. If we're talking about the average Joe who is not a real estate professional, how can they potentially deduct their rental losses?
I feel like I have never felt so inferior, smart-wise, at a podcast
Smart-wise.
before.
I couldn't do what you guys do. Oh my goodness.
So, generally speaking, you're a real estate professional. Is it better to buy just a regular old long-term rental or a short-term rental for tax purposes?
So I would say with the long terms, you already qualify as a real estate professional. And if you have multiple long-term rentals, we can group them to meet the material participation test. And then you're able to deduct the losses from those long-term rentals.
Okay.
When that's sort of like the ideal, but still with the short-term rental, if you guys still materially participate and can meet those tests, we can take those losses as well. And we can group, can we group your short-term rentals? I have to double check on that. I know the long terms for sure we can group to kind of count them as one unit. Okay. So you're not having to meet the test for each one.
Okay. Back to you, Nick.
Sorry, Nick. I try so hard to explain it. It's so hard sometimes. I try to explain it in a way that everyone can understand. Because sometimes we get wrapped up in our nerdy accountant land. And part of what we do is, and what makes us special, is we try to explain it in a way that everyone understands.
You are worth every penny I pay you. Charge me
I don't
double.
want anybody explaining it. But yes, Nick.
Okay.
Nick and his notes.
Yeah.
Nick and his notes.
And then one other thing with short-term rentals that you kind of have to watch out for is personal use. Because if you personally use your short-term rental over 14 days, then you have to start allocating expenses to your own personal use, and you can't take them all. Now, if you're under that 14 days, you can deduct all expenses, and you don't have to allocate anything to your own personal use.
So that's kind of the magic number. It's 14 days or less than 10% of rented days is kind of the personal rule.
Okay.
So kind of bare bones, a lot of my clients just have that 14 days in their head. I'm going to not use it more than that, and then we don't have to limit your deductions. Now, what's personal use? So if you're going to the property to work on it, do some repairs, meet the furniture delivery person, that's working days. Those aren't personal use days. But you're taking the family to do, a week-long vacation at the beach and stay, okay, personal use. If you go over those days, it's not the end of the world. We just can't 100% deduct insurance, mortgage interest, real estate taxes. We're going to have to do this allocation, and some of your deductions will be limited.
Is that based on how many days you go over, or is it?
It's based on the personal use days, but they don't come into play until you exceed that. So not all lost, it's not the end of the world, but some of our clients, just to kind of have in their head, will make sure they stay under that, or if they're going to go visit the property, make sure they're working on it. They're doing a little bit of painting. It's a work day and it's not a personal use day.
Got it.
That's a good one. Because a lot of people, you buy a house in the mountains, you buy a house at the beach, and you're like, well, I'm going to use it personally.
Yeah, you don't think
come
about
on.
that.
Yeah.
No, but there's all these rules.
Yes.
Yeah.
Sorry, there's always rules.
Yeah.
Yeah.
Yeah. Did you have anything else?
And then also kind of on the flip side, where if you wanted to rent your own house out for less than 14 days, then you don't have to pay taxes on any of that income.
Wait, your
So,
primary home.
Your primary home, yes.
So Spoleto Festival, rent it out and tax-free. Huh?
Yeah.
Right, yeah. So
Wow.
if you want to go
Yeah.
on a vacation and
Yeah.
then rent your personal house out at the same time to kind of help pay for that vacation,
Yeah, that's
you won't
fun.
have to pay taxes on any of that income.
I should do that for Bridge Run weekend.
And everybody's different. These are the tax rules, but I know my husband's extremely OCD, and he would never
Allow
let
somebody in the house.
Yeah.
Yes, and your residence. I think it's different when it's
For sure.
your investment property and
Right.
people are staying there. But
Oh, I'm already thinking the list of rules I would have to leave.
And I was just thinking, I don't care.
Yeah.
I'll leave all my shit there.
Yeah. You let ayahuasca retreat at your house where
Yeah,
people were
I did.
diarrheaing all over the place.
I finally retired that couch yesterday.
there's a story there.
Yeah. Oh, yeah.
Anyway,
So tell us about your podcast.
Yeah, so I have a podcast with one of my friends from college. It's called Weights and Wealth. It's mainly around personal finance and then also fitness because I'm interested in both those things, and so is my buddy. So we figured that we would just start a podcast about it because we talk about that anyway. So we just said, why not just record ourselves talking about it?
It's awesome.
Yeah. And the wealth part, is it just like about accounting, or is it building wealth, or all of it?
It's around building wealth, and it's more geared towards people that don't really know much about it at all. So mainly, we try to go for more high school kids or people that just graduated college, in that age range. And, it's just the basics on like retirement. Like we did one episode about the Army's retirement plan because the guy that I do it with is in the Army. And he was telling me that a lot of the guys in the military don't invest in retirement. And we're basically explaining how your investment compounds over time and how much you'll have at retirement if you actually utilize the retirement program they have.
And do you talk about real estate much on the building wealth?
Not
top
a
three?
whole lot. We did do one on short-term rentals, which I had to do a lot of research on, and because I'm not an expert, because I don't have one myself. But as far as real estate goes, I would say that's really the only one we've done.
Okay.
I have a question. So, how many people are in your office?
Oh goodness, are we like
You have like
12?
12, yeah.
12 now?
Are you like inherently with your own personal finances, obsessive and like tight and just trying to capitalize on everything?
I am not. I know it kind of varies from person to person. I'm not. I try to keep a budget, but I just kind of ballpark it.
Yeah.
So
Same. You would think my husband's not an accountant, but he's way more anal OCD than I am. And y'all are going to laugh. We've end of the month meetings. We get together and last day of the month, I kid you not, end of the month, and pull up our budget spreadsheet. Where did we land? What's coming up? And I'm the ballparker. There, I'll never forget one night. I hate end of the month. I hate it. I look at other people's numbers and spreadsheets all day. I don't want to look at my own. But Nick gets his Corona Light and he moseys on over. He's got his notes.
He loves it.
Oh, he loves it.
Oh my God.
And I'm like, oh.
It's like my worst nightmare.
Oh, it's awful. But there was one night where I was like, I couldn't find, I don't know, it was like $1.16, something. And I was like, immaterial, move on. And he was like, what do you mean? You're the accountant. Where's the 16 cents? And I'm like,
Wow.
there's an immateriality feature here and we're moving on. Miscellaneous, move on. And he was like, well, I don't understand. Why can't you? I was like, you're killing me. But I will say, we started our marriage with separate bank accounts. We did not want to merge them at all. And we said, okay, what are our household bills? This is before kids. And I said, okay, well, you'll pay the utilities. I'll pay mortgage and groceries, like however we divvied it out that we felt was fair. Well, he was paying the utilities, I know that, but I was doing the grocery shopping, but he was paying groceries. So he'd cut me a check once a month for groceries. Well, then we started sounding like roommates. So there was like, I left the lights on one day and he was like, shouldn't care, shouldn't pay the light bill. And then there was like, he was adding like a more Corona Light to the grocery list every week. And I was going over grocery budget than what he gave me for the month. And I'm like, well, now I'm getting screwed. We sounded like roommates. And so after and no savings goals at all. It was just like end of the month, it was like, do you have anything left to put savings? I don't know, whatever. We were young. We got married at 24, so we were young. So after about 2 years, I was like, okay, we've got to get on the same page here. So we got a joint account. We did a monthly budget. We give each other allowances. Stacy's going to die laughing. So once a month, we each get an allowance. And the biggest conversation was what kind of expense is a joint expense and what's an allowance expense. That was the biggest kind of hash out, I guess. So he wants to buy, fishing supplies, whatever. Like, that's your allowance. I want to go buy another pair of shoes. That's my allowance. Don't question why I now have, 20 pairs of shoes. And did I need that pair of shoes? That came out of my allowance. Don't worry about it.
Yeah.
If I want to save up my allowance to I don't know, just it's whatever I want. It gives you that, And so the allowance numbers changed over the years. You have kids, you're paying for daycare. Allowances got cut. Kids are out of daycare, frees up some cash, allowances go back up, whatever. But that's the biggest discussion, which I swear, saved our marriage. I mean, we see it all the time with clients, and if you're not on the same page with having those conversations, and as much as I hate end of the month,
Yeah.
It's good. It's good. We have goals, we have plans. So everybody's different when it comes to that. But yeah, I'm with Nick. I'm like ballpark. Yeah, we went over the eating out budget, but guess what? The power bill was a little less than we budgeted. So it all washes out. Whereas my Nick is like, but I
can't even imagine. I mean, I told my boyfriend, he said to me early on when we first started dating, he was like, babe, we can never have a joint account. Like, we can never, the way that I spend. I mean, you would say the same thing being married to me.
Yeah.
And, I told him, I was like, you're not allowed to ask me how much anything costs anymore. Because he says it's because he's Italian, which I don't know if that's actually a thing, but it was like, no matter what I was doing for myself, coming from a tight, his mom grew up in a house with 10 kids. Yeah. So they were pinching pennies.
Yeah.
Anyway, that's not happening with me.
I'm still a big proponent of separate bank accounts.
Yeah.
In marriages.
Well, how do you guys do savings and is he more the saver, you more the saver? I don't know, then you throw kids in the picture. It was college savings so y'all just separate everything.
Yeah, well, I think it also is more fair because our incomes are similar. But he is not organized whatsoever. I mean, if he were in charge of utilities, we would not have air conditioning. It's just, I pay all of the bills, the mortgages, the utilities, the groceries, everything. He gets to pay the tax bill at the end of the year.
Got it.
Or the estimated payments. It kind of all is a wash. And then he probably has more in retirement than I do, but that's because he's older and has had more time to contribute.
A little.
But it works for us.
Yeah. It really is whatever works
for sure.
Yeah.
It's so personal. So talking about retirement, what do we need? Like, we're going to wrap this up here, I think. But what do we need to know? Has anything changed in terms of retirement? What are you telling people to do?
So
what do we need to know?
With my business owners, SEP IRAs are huge because you can fund up to, I wish I had a cheat sheet.
66,000 this year.
Nick. Yeah. 66,000 into a SEP IRA. You have the simple IRAs, you have, the 401ks and deferral limits. All of that kind of goes up a little bit each year for inflation. So as we're doing our year-end planning for clients, we'll take a look at their latest pay stub. Are you maximizing your, 401k deferrals? Let's make sure you're doing that if cash allows. And then based on your net business income, what is the additional you can fund? And there's different deadlines for that. So your SEP IRAs, you have until you file your tax return to fund that. But your 401ks, any salary deferrals, that's a calendar year end thing. So we try to look at all retirement options for our clients. Some have the simple IRAs and you want to maximize that through your salary, but then also if there's the profit share component, that's a business deduction. So we go through all of that with our clients and the different options they have. Traditional IRAs too, 6,000 I believe this year, goes up to 7 next.
Yeah, I think so.
Yeah. Some things have adjusted for inflation.
Well, you are taking on new clients again.
Finally.
I send a lot of people to you because you have never messed up. We love you. So tell everybody how they can find you if they're interested in.
Yeah, so we're with Carr, Riggs & Ingram or CRI. Check us out on our website. I don't even know this. Google CRI. Carr, Riggs & Ingram.
The Mount Pleasant office.
The Mount Pleasant office. It might be listed as the Charleston office. We're the only South Carolina location in the company. We have locations across the southeast. I believe as far west as maybe New Mexico, but no further north past North Carolina. So still very southeast, headquartered out of Enterprise, Alabama. Okay. A lot of locations in the South, but it's where you can find us. I'm on LinkedIn too. You're on LinkedIn, aren't you? Yeah.
Not too active on it, but I do have one.
You have one. So
and mention your podcast again. And is your podcast on Instagram?
We are. It's W&W Podcast on Instagram, and it's Weights and Wealth is the name of it.
Cool.
Awesome. Well, we love you guys. Thanks for being awesome. And thanks for coming back and updating us. And I will not be shocked if this is the number 2 downloaded podcast of all time on B2B.
And I didn't understand a damn thing.
Oh my gosh.
Anyway, thanks for joining us. Thanks for tuning in. Don't forget to rate, review, and subscribe. And check us out at Between Two Brokers and at Smith Spencer Real Estate on Instagram. And we will see you next time.